Hey, I'm just putting together a quick video that discusses weekly versus monthly dividend compounding. This is something I glossed over pretty quickly on one of the previous videos, so I thought I'd do a short one that covers this topic. Um, this is something that has come up in the high dividend investing community, and although I don't think weekly versus monthly dividends should really be the focus right now, given what happens to the NAV on a lot of these funds. Um, it's still something that people are interested and concerned about, with a lot of people preferring the weekly payouts that some of the round hill funds make, like XDTE, QDTE, and the soon to be released tomorrow from the dates we've seen, RDTE, versus maybe like what Yield Max is doing with the monthly payouts. Does it really make a difference? Certainly, there are other reasons why some folks may prefer weekly dividends over monthly. Perception that the compounding returns more quickly will make a significant difference is paramount, of course, although it might not. More frequent paydays, easier cash flow management for those using dividends for other purposes than just reinvesting them, or stacking them up in the account. Offset timing from other dividend payments or reinvestment rotation into other assets. Maybe someone wants to take dividends from something that pays at the beginning of the month, try and get it into a fund or an investment that pays in the middle of the month before the ex-div date, and so on and so forth. That's certainly something that some people can and try to do. Or maybe everyone just likes an additional ADHD dopamine fix from updating their spreadsheets more often. Who knows? Regardless, the actual compounding difference, if we just look at some sample annual returns of 10, 20, 40, 60, 80, and this is really just kind of to bracket them into some ranges to see what that actual variance works out to. We can see at 10 or 20%, we're really not making a significant difference whether those funds are compounded weekly or monthly. And again, this assumes that wherever it's invested before it pays out, that they're not compounding that money for you anyway. Regardless, you see at 20%, we're talking about 0.15%. I know as investors, we'll all take the 0.15% all day long, but it's really not a significant difference annualized. Now, when we start getting to 40%, yeah, you're talking about 3/4 of a point. I mean, who of us, when we're evaluating investments, isn't trying to squeeze an extra 3/4 of a point out of something if we can safely? But then you get into these 60 to 80% return rates, especially with some of these higher paying yield maximizing funds, and a weekly payout could make a little bit of a difference, right? At 80%, you're talking, if you get $100,000 in something that's paying those kind of distributions, then yeah, you're talking about an extra $4,000 a year if you can compound that up weekly instead of on a monthly basis. So certainly at those higher levels, it could make a difference. So anyway, just wanted to get something really quick put together that highlights what these differences really are. Certainly, if anyone has any questions about the math, the approach to this, or has any kind of request for something maybe they'd like to see, or any other just general questions, put them in the comments section, or feel free to send me an email, questions@financialfreedommedia.com. Have a great rest of the day. Thanks.